Now, Don, I think you're going to be the biggest bull in this panel, I think. And you and I were rejoicing yesterday at the great stock market performance, stocks trumping oil. But today, the reverse trade set in. I'm very frustrated. I'm very cautious. And I want to know if you are considering a little cash raising even while you invest.
Well, don't portray me as just sort of a blind bull that's just charging forward no matter what. I certainly recognize that there's an awful lot of chaos out there. But, Larry, you've just got to admit one thing. Something is going on here because we still have only had about a 2% correction in stocks, even while oil has just gone crazy. And the oil price made a new high today in this move. Stocks did not make a new low in this move. There is some underlying strength that's going on in the economy and in the stock market. There is some underlying value proposition there that is so compelling. It's going to take something a lot more than 105 oil to knock it off the perch.
All right, I feel better already. Let me go to Jim LeCamp.
There you go.
He'll probably make me feel worse. Jim LeCamp, I want to ask you about this little kernel of wisdom that cropped up in the jobs report, which was a very decent jobs report for a change. However, in February, wages did not rise. And we know that in the last month, 6 weeks, gasoline prices have increased a lot. Now, how are we going to pay for the higher gasoline prices at the pump if wages aren't rising? And does that foreshadow, foretell a very poor consumer spending situation?
Well, there's a dual-edged sword there, and they're both edges are bad because either these costs are going to be passed along to consumers or the producers are going to have to eat these costs. And it's not just fuel. Everybody's talking about oil the last week, but let's look at what the prices of all commodities have done over the last 6 months. Now, Ben Bernanke can blame weather, but these prices were moving well before weather. These are the result of not only global growth, which is good, but rampant money printing, not only in the United States, but in Europe, Japan, and elsewhere. And it can't be passed along. It can't be absorbed by consumers. They're already over-indebted. Consumer spending has outpaced consumer incomes, as you point out. And so things are not getting healthier on the consumer front. In the meantime, corporate profits are going to take a hit from higher input costs. So it's an absolute concern
so therefore,
moving forward.
Are you selling? Are you raising cash? In other words, 50% cash, 80% cash? What are you doing?
No, we're still long, but if you look at our portfolios, a lot of our portfolio includes these reflation themes. We have coffee in our portfolios. We have fertilizers in our portfolios. Caterpillars, we're short the dollar, short the treasury. So we don't have a lot of cash, but our accounts were up yesterday and today because we have this mix of reflation themes in there.
All right, Ted Parrish, you've heard the two prior panelists. I want to ask you about the reflation trade. I want to ask you about your worry. No wages to pay for the higher gasoline prices. Are consumers going to suffer? For example, are you selling retailers, particularly middle and low income retailers like Walmart and Target and the various Dollar Generals? Are you selling them, Teddy?
Well, we sold Walmart recently, and that was more of a, I think their business model is trying to chase after the dollar store type market, but all in all, we still have a pretty sizable stake in retail, not above the market weight. What we've done, Larry, is try to focus on companies that can pass along higher inflation to consumers. We did a study and found that technology, industrials, and consumer staples have the ability to pass along those costs, whether it's from the use of leverage and also supply chain management. But we see good things ahead for the market. I know that this Middle East situation is a pretty big deal, and it's going to drain the consumer's wallet a bit, but we don't think we're at the point of demand destruction that's going to throw the growth engine, the growth story off track.
No, there's no question up to now. The growth story looks pretty good. I mean, that's an important theme coming out of the ISM numbers and even today's jobs report. It wasn't spectacular, but it was quite decent. Don Luskin, though, you heard Jim LeCamp talk about the reflation trade. Okay, and this week, oil up enormously, we know that. Gold up enormously. The dollar down. The dollar keeps sinking. The dollar's like over the yard arm now. I can't hardly see it as the sun sets, Don Luskin. What does that mean for the investment strategy? Mr. Bernanke doesn't care about the dollar. He doesn't care about gold. He doesn't care about oil. I don't know what he cares about, unemployment, but unemployment fell today. Don, is the reflation trade the best possible thing now?
I think so. The short the dollar is the same thing as saying reflation, long gold. They're the same trade, just sort of upside down or in the mirror. Ben Bernanke is he doesn't want there to be runaway inflation, but on the other hand, he's not particularly here to defend the dollar. His economic thinking comes from a sort of an old-school mercantilism where he looks at the gigantic trade deficit the U.S. has been running, and he says, goodness, the exchange rate has just got to equilibrate. I don't know why the dollar isn't much lower than it is. So when the dollar goes down, it doesn't alarm him because it's something he's kind of been wondering for the last 10 years why it hasn't happened. So for him, that's not a constraint on his action. If anything, he sees it as a good thing. He sees it as part of this mantra of global rebalancing, which is what they love to talk about at the G20 over cocktails.
But Don, is that a constraint on your investment? If you have no confidence in the dollar.
No, it's not, Larry.
There's a big story in the Wall Street Journal this week how the dollar's reign is over. If that is that a problem for you?
No, it's not a problem, and here's where I actually agree with Bernanke, although I don't agree with any of the theoretical path by which he gets to this conclusion, and that is the United States, whether you know it or not, or whether you believe it or not, has technically been in deflation for the last 2.5 years. The Consumer Price Index is exactly where it was 2.5 years ago. That is deflation.
Whoa.
We've got to get a little bit of inflation. Not a lot, but a little. A little is good.
Jim LeCamp,
and that's what Bernanke is trying to do.
Jim LeCamp, do you see a lot of deflation out there?
Yeah, we have deflation in the wrong areas. We have deflation in the housing market. We have deflation on the assets that debt is attached to. But we have runaway inflation on things that are in people's pocketbooks. Fuel, food,
it's not the numbers,
all
Jim.
these things.
It's
Cotton,
not in the
copper.
statistics.
And it's... Well, not in the core number. And if you gauged inflation like you did 30 years ago during the Carter administration, you'd have a 10% running inflation right now. The producer prices are running at 10% inflation right now.
I don't know. Personally, I was always fond of the Coolidge administration, but we're just talking about the experience of investors right here, right now.
I love Calvin
Okay,
Coolidge,
the experience is that they're paying